In today's video, we are going to explain yet again why it is that the Federal Reserve wants a higher inflation rate to raise the neutral interest rate. Now, I know this is something that a lot of people have heard from me quite a bit, but I had a few people comment saying, what is it you mean by them wanting to raise the neutral interest rate? And what would be the point of that? In fact, Charlie, who had just commented on yesterday's video, pretty much asked that very question. He says, he said that I keep referring to them wanting to secretly trying to increase inflation and the Fed neutral rate. Now, I think that question was a little bit misstated, because really what I've been saying is that they are trying to increase inflation to raise the neutral interest rate so that the neutral interest rate will then move towards where the Fed funds rate is today. The Federal Reserve wants to be at neutral, but neutral is very low. So he goes on, he says, can you please explain why they would want to do that? So this video, we are going to explain, again, why it is that the Federal Reserve is sitting in a position in which that they want elevated inflation to raise the neutral interest rate. Now, I have said this many times in the past, and I get it why people are very confused, because they listen to a lot of economists out there and what it is that's going on, and they just get absolutely just boggled in the mind with all this information, and never once ever hear about the neutral interest rate or how that was affecting the Federal Reserve and their monetary policy and why it was screwing it up so bad. So we're going to talk a little bit about why it is that they're trying to push for a higher inflation rate. So we're going to take it back a little ways to the great financial crisis, and the Federal Reserve had lowered the Fed funds rate to zero. This was the zero interest rate policy. A lot of times you heard it referred to as ZIRP, right? Zero interest rate policy. So now what had happened is that the Fed funds rate had essentially dropped to zero for the great financial crisis. So this is right where the great financial crisis was kicking in. They dropped the Fed funds rate to zero, and they kept it at zero for nearly 10 years. I forget exactly how long it was. It dropped it down in like the end of 2007 into 2008, and they carried it to like 2018 or something, when they started to go into what they referred to as the autopilot program. You guys remember the autopilot program from the Federal Reserve? This was back in 2017-18, when they started to slowly raise the Fed funds rate, right? So they were trying to kick it up like a quarter point every quarter, and they got it up to about 2.5%. And that was as far as they could go. The markets were getting pissed off. This was like 2018, then going into 2019, they started to drop the Fed funds rate. COVID kicks in early 2020, and they dropped the rates back down to zero, and they were at zero during COVID, right? So now that's what happened with the Fed funds rate. Now, the problem with this is that the Federal Reserve here, when they were at 2.5%, that wasn't enough room to drop the Fed funds rate to stimulate the economy. Now, typically, the Federal Reserve would want to lower the Fed funds rate around 5 percentage points. This would be enough to get the economy moving again, as that lower interest rate would entice people to go out there and borrow money to buy houses and cars and go on vacation and spend that money into the economy. Now, it goes a little deeper than that, because really when they lower interest rates, it also sparks business investment. And so then you'll have businesses out there expanding operations, building new buildings, and buying equipment, hiring people. And that hiring of people is really what the Federal Reserve is looking for when they lower the interest rates. This gets the economy moving. More people are working. When more people are working, more people are consuming. When you have more people consuming, then you have supply-demand imbalances, and the inflationary pressures start to arise. This is how the Federal Reserve used to conduct themselves. So lowering the interest rates would eventually move into employment and causing the employment to move up. However, when the Fed funds rate hit zero, there wasn't enough room to actually raise it up to the 5% in order to drop that 5% to stimulate the economy. Even if they were to get it at 5%, it still wouldn't have worked. And the reason is because there's something else that's involved called the neutral interest rate. I know this is kind of a messed up graph, but you guys get it. The neutral interest rate during this time of the great financial crisis had also been dragged down near zero. So now for the previous 10 years up to this point, going all the way back to the great financial crisis, the neutral interest rate had fallen all the way close to or right around the zero interest rate as well. They had estimates that it was somewhere between 0 and 1.5%. There's no real way of telling where the neutral interest rate is. You can look back over time and see where it was at. But at this time, they didn't know exactly where it was, and they know that it was very close to 0 because the Fed funds rate was not stimulating the economy when they got it down to 0. So this is the neutral interest rate. This is the reason why they had to go into the massive quantitative easing, because the lowering of interest rate wasn't enough. That wasn't going to stimulate the economy. They had to go into massive asset purchases, which means firing up the printing press and then buying up a bunch of government bonds and mortgage-backed securities. That's what they were doing during the great financial crisis in order to create the economic activity that they needed in order to stimulate, and get things moving again. The lowering of interest rates wasn't going to do it. And the problem is that once the Fed funds rate gets to 0, the return on capital investments actually goes negative. So the problem that they were facing then is that with a low Fed funds rate or low interest rate close to 0, this is actually a deflationary aspect to the economy. Most people don't see it that way. They think low interest rates creates inflation. That is absolutely incorrect. From the great financial crisis, it was proven they printed up $4.5 trillion. Well, they took the balance sheet from $8.5 billion to $4.5 trillion and failed to produce the inflationary scenario. So to simply say money printer go burr, prices go up, that is very naive to talk about or say it in that fashion, because if you go back to the great financial crisis, then you're going to find that none of that makes sense because it doesn't work. Right? It didn't create the inflationary scenario that the Federal Reserve was looking for. This is their major problem. This is the reason that they are now conducting themselves with an idea of raising, not the idea, the actual plan to raise the inflation expectation. And here's the reason why. Okay, so we take it back to the great financial crisis again. The Fed dropped the interest rates to 0 to try and stimulate the economy. But the problem that was taking place is that it's not going to stimulate the economy because they would not be able to get far enough below neutral. The neutral interest rate ticked right along with it until they get to COVID. Right? Low neutral interest rate until we get to COVID. We have the COVID pandemic, recession, all the problems that come from that, and all of a sudden supply chain breakdowns and stimulus packages go out and we start finding the inflationary pressure coming from it. All right, so now we have this inflationary expectation that is running very persistent within the economy, and it's quite elevated when you got people out there saying 9, 10, 12% inflation rate. This starts to raise the neutral interest rate. So now let's take it back again, because the Federal Reserve, right, was at 0. They rapidly raised the Fed funds rate up to 5.5%, right, only to bring it down just a little bit. So this is essentially what the chart looks like today, right? They went from 0, ran it up to 5.5%, 5.5, and then dropped it down 1 percentage point. This is what's going on with the neutral rate. So as the inflation expectation was elevated and the people are demanding a higher return on their capital investment, and the concern that is elevated out there causes the interest rates to be elevated, right? If you are worried about inflation, if you are worried about economic uncertainty out there, you're going to demand a higher return on your capital investment, which is going to raise the interest rates, and this in turn is also going to raise the neutral interest rate. So now with the elevated inflation expectation and the raising of the neutral interest rate, what ends up happening is as the Federal Reserve is standing still here after dropping 1 percentage point, as the Federal Reserve is standing still and you have the tariffs and the uncertainty and all the crisis situation and all that other stuff that raises that inflation expectation, it will raise the neutral interest rate, moving it ever closer to the Fed funds rate. That makes this restriction between the neutral interest rate and the Fed funds rate diminish, right? There's less restriction. Man, it's really starting to come down. So there's less restriction taking place within the economy when you have an elevated inflation expectation and the raising of the neutral interest rate. So once the neutral interest rate starts to move up and making the restriction less on the economy, now the Federal Reserve is sitting in a position in which that if they can continue to raise that neutral interest rate, the Fed funds rate will be neutral. They won't have to move. They can just stand right where they are at elevate the inflation expectation, move the neutral interest rate up so that it meets where the Fed funds rate is today or very close to it. And this gives them the ability to now, during a downturn, drop interest rates to zero, be far enough below the neutral interest rate that they could actually stimulate the economy. This is what they're shooting for. This is the reason why we have all this chaos and uncertainty and messed up situation taking place out there that has everybody elevated with their inflation concerns based off of tariffs or whatever it is that's coming out there. I mean, there's so many credible threats from so many angles. You can just pick your flavor of them. But ultimately, this is the reason why they're doing it, is so that they can get that neutral interest rate elevated so that when it does come time to stimulate the economy and they do drop interest rates, they can drop them far enough below neutral to stimulate the economy. That's it. That is it in a nutshell. Now, all the other stuff is a symptom of this. Right? All these people saying, oh, no, they got to push the Federal Reserve to lower interest rates. No. Okay, that's a great story, and it does make a lot of sense. And, refinancing the government debt and all this other stuff. I mean, I've heard this story time and time again, right? But very rarely do I hear anybody talking about the elevation of the neutral interest rate to give the Federal Reserve the position of being neutral when they had the Fed funds rate elevated. By being in that position, the downturn in the economy is now got the ammunition to deal with it, right? The Federal Reserve has the ammunition to deal with the downturn in the economy. Like, we can keep breaking this down, but this is it, all right? Over time, the neutral interest rate continued to fall. Like it took over the course of the last 25, 30 years, there was ever dropping of the neutral rate. It kept falling. And there was three main reasons for this. The three main reasons was, one, it was a demographics issue. Across the globe, the industrialized nations, the big economies out there have an issue with demographics. There is an growing older population and not as many young people being replenished into that population, right? So we have a demographics issue, older population, yet less younger population. Now, the reason why I kind of state it that way is because you can not fix it, but change the situation with immigration and stuff. But ultimately, this is what's happening, right? When you have an older population within an economy, then they have a tendency to slow down on their expenses, right? They don't buy as much stuff. They're not buying, all the kinds of things that a younger individual would do when they're, building their life up or whatever. So generally, older population does less activity within the economy. This slows the economy down. This is part of the reason why the neutral interest rate was coming down. The other part was a slowdown in global growth. Right? So around the globe, same thing. We had this issue with global growth taking place, or the lack thereof. Therefore, the neutral interest rate was falling along with the rest of the interest rates that were out there. And then the last one was a widening wedge. And this is I know this is a very difficult. This is the reason why I'm saying this is because this is what the Federal Reserve was saying, right? The last one, the third reason, was because of the widening wedge between safe and liquid assets like U.S. Treasury government debt and that of corporate bonds, right? So now the corporate debt had a higher interest rate, a higher yield than the U.S. Treasuries, which were very close to zero. And again, this was creating a situation in which that we had a slowdown in the global growth, the economic activity, and that neutral interest rate was coming down. Here's a good way to kind of look at it. If you have a U.S. Treasury that is very close to zero with a very low interest rate, even today at 10 years at 4.3%. Had you gone back to the early 80s, and if you had a rich uncle leave you $1 million, you could take that $1 million, lend it to the United States government by buying up U.S. Treasuries. You buy the 10-year Treasury, you had a return of somewhere around 15%. You could lend the government $1 million and have a return of around $150,000 a year. That was a pretty good amount of money, especially in the early 80s, and that's a lot of money you can redeploy back into the economy. So this is one of the reasons why low interest rates creates a deflationary aspect to the economy. Higher interest rates actually is good for the economy over time, because that return on the capital investment can then move back into business investment or consuming or whatever it is that's going on out there with the individual who had that return. But ultimately, the higher interest rates on the U.S. government debt back in the day created an environment of economic activity. Right? Well, here, same situation. You get, rich uncle leaves you $1 million. You lend that money to the government, and you have a return of around $45,000 a year. Right now, that's not bad. It's not like $45,000. That's a lot of money. Don't get me wrong. Right? But that's not nearly the $150,000 a year that you would have gotten back in the early 80s. Right? So this is the situation that the economy is now in, with a low neutral interest rate that is now, being reflective of a slowdown in the economy that is not one in which that the monetary policy from the Federal Reserve can continue to be conducted in. Like, the Federal Reserve doesn't have the ability to drop the Fed funds rate and actually create a stimulating effect within the economy. It's just not going to work like that. This is one of the reasons why they have this quantitative easing that comes out every time they're doing the stimulus packages, because all that quantitative easing and the fear of inflation that comes from the money printer has a stimulating effect within the economy that creates an inflationary scenario based on the expectations of it. People get very upset when they hear that, because they believe that the money printer is the main reason why we have inflation. And if you were to take that consideration, then you're going to have a very difficult time understanding why it is that quantitative easing 1, 2, 3, and 4 failed to produce the inflationary scenario that the Fed was looking for. Without that understanding, you will never understand the monetary policy coming from the Federal Reserve, because that was their major problem. They expanded their balance sheet by 4 times. They took it from $850 billion to $4.5 trillion and failed to produce an inflationary scenario. How is that possible? Right? It's because of low interest rates. That zero interest rate policy is a deflationary aspect to the economy. And once you see it, once you recognize it, it makes a lot more sense to why it is that the Federal Reserve is conducting themselves the way that they are. They don't need to adjust interest rates in order to create a stimulating effect within the economy. Think about it. They have promised interest rate cuts sometime in the future. With that delivery of that message, it started to lower the mortgage rates. Think about that. They can stimulate the economy off of their words. If they were to tell you, hey, we need to cut rates because of economic uncertainty and recession and all kinds of stuff that was out there, those mortgage rates would have moved up. They would have moved up. People would have been like, oh, hell no, there's recession. I ain't deploying my money. I'm not doing any of that stuff. And you would have seen the mortgage rates move up, as the banks would, and everybody else would have been concerned on whether or not the people would have been able to pay that loan back. If you have a recessionary delivery or a recessionary pressure delivered with the message saying this is the reason why we're acting is because of bad employment or labor market or recessionary pressures or whatever that's going on out there, that will start to raise the interest rates. It'll raise the mortgage rates. The Fed doesn't have to do anything. All they have to do is promise the future that that's what they're going to do and the reasoning that they're doing it. However, that's not what they did. They're delivering the message right now saying, hey, we're going to be supportive of the economy. Here's some point in the future. We see that time in June or something like that. We see it out in the future, but they're not talking or delivering the message with the recessionary pressure. Since they're not doing that, they're delivering it with, hey, we're just generally supporting the economy. What do you see happening? You see the mortgage rates coming down, quite opposite. All they have to do is just deliver that message. That's it. They don't have to deliver an action. Think about it. They're sitting still right now, delivering a message that is creating a reaction within the economy. It's creating a surge in mortgages. Like a surge, I don't know, the 11% surge after the market has tanked is not really a surging, right? It's just an increase in mortgage issuance, but it's based off of the idea that the Federal Reserve is not doing the cutting for recessionary purposes, but doing it as an expectation of market support. right? And that's all they need to do is just deliver that message in one of those two ways, and you will have an outcome of either increasing the interest rates or decreasing them. But they don't have to actually do anything. All they have to do is just deliver the message. Angry Capitalist, $5. Thank you so much. Simon, what are your thoughts on malinvestment from artificially low rates? Could the Fed getting rates higher lead to more productive capitalization? I think it does. I mean, I think anytime that you have a higher interest rate, see, this is the problem that we now face, is that everybody kind of sees it in a way from a debt-based currency system, in which that the lowering of interest rates is somehow inflationary and the increase of interest rates is deflationary, right? So like lowering interest rates gets the economic activity out there, people borrowing for houses and cars and going on vacation and all that other stuff. Higher interest rates slows all that stuff down. Now, that is like the common belief of just about everybody out there, and including me in a lot of ways. However, if you go and you read the Cantillon essay, what he says is something far different. And that when you have a hot economy, when people are very active, when there's a lot of participation going on within the economy, the demand for money increases. Entrepreneurs are looking to acquire money so that they can buy material to participate in the economy with. So they want to borrow money. The more they want to borrow money, the more the interest rates go up. It's a supply and demand issue. People with money see that there's people out there who are demanding it. With the increase in demand, they have an increase in price. The price is the interest rates. So this is really where an economy starts to find higher interest rates, is when the economy is active, when it's ramping up. Right? If you have an economy that is slowing down, then everything else be opposite, right? If you have people who are wanting to get a return on their investment, but they can't find anybody to borrow money, they keep lowering the interest rates until they can find somebody to borrow the money. This is how Cantillon described it from way back in the day, from 200 plus years ago, and that makes a hell of a lot more sense. See, we had low interest rates after the great financial crisis. Quantitative easing 1, 2, 3, and 4. All this money printing, low interest rates. We had almost a deflationary aspect to the economy. They could not find the 2% target. They couldn't get there. It ran well below 2% pretty much consistently the entire time, even though they had printed up all this money and everybody out there was screaming hyperinflation, including me, right, at the time, and it didn't happen. I had to change the way I looked at view things to understand why it is that it didn't occur and why it is that the Federal Reserve is conducting themselves the way they are today, and it's all based around the neutral interest rate. If the neutral interest rate is low, the Federal Reserve cannot drop the Fed funds rate far enough below the neutral rate to stimulate the economy without hitting the lower bound of zero. Go listen to Jerome Powell's speech that he just recently gave, and listen to the Q&A section after, or the Q&A portion of it after the speech. This is, as soon as he starts talking in the Q&A portion of it, this is exactly what he is describing. He said that the Fed funds rate was near the lower bound of zero. This is the problem that they face, and that if they go into a recession, they're going to hit the lower bound. The lower bound is the problem, and they are blocked by it. They can't keep dropping interest rates below zero without going into negative, and that negative interest rates is not something that has proven to be successful or even works in the economy. In fact, if you are remained in a negative interest rate, most likely you are going to have to be in a cashless society. So they know that the lower bound of zero is their limit. They cannot go any further below it. And stimulating the economy with a very low Fed funds rate that hits the lower bound without much of a drop below neutral is not going to stimulate the economy. It's just not going to work. This is where all the money printing and deployment of that money going out there into the system starts to create an inflationary expectation. Oh, money printer go burr, prices go up, and everybody says, okay. They run out there and start hoarding up and buying before the prices go up, and then they're allocated again, so they buy even more of it because they're afraid they're going to be limited on it. It's just like it starts creating the issues that we had experienced. They didn't even come close to getting what they wanted out of the quantitative easing 1, 2, 3, and 4. COVID totally worked, right? It totally worked for them. They got all the inflation that they needed. They are now sitting moderately above 2%, which is exactly what they are looking for to continue to raise the neutral interest rate, which is what they are doing. And every time we have another credible threat of tariffs or anything that has really created the uncertainty that we are now expecting within the economy, it raises that inflation expectation and it moves the Fed ever closer to their goal. Actually, the Fed doesn't move anywhere. They just stand still. The neutral rate moves ever closer to their goal, which is them being still and the neutral interest rate being at the Fed funds rate. All right. $5,000 Doge checks coming soon. Can't wait. Whatever. We'll see. All right. Well, first off, it's not anything to do with helping the economy or you and me. It's simply that they are the buyer and the lender of last resort. It's basically to screw us. Well, government costumes, that's the meaning that you have given it. And since you have given it that meaning, that's probably exactly what it'll do to you. However, I don't give it that meaning, and so therefore it doesn't screw me. Like, I don't feel screwed by any of this stuff. I understand what's happening. I don't like it, but then again, it's not up to me to like or dislike. It's up to me to understand what it is that's happening so that I can position myself for it. Now, if you're thinking like it screws the guy who doesn't pay attention, who wants to go to work every day, collect his paycheck, and just like, drink beer and watch football after work and not like, pay attention to any of this stuff, yeah, it's going to screw him big time. Big time, it's going to screw him because he's not preparing himself to deal with the situation accordingly, right? So yeah, that person's going to get screwed big time, but that's their own fault for not paying attention. This isn't a game of fairness. It's not. It's survival. It's survival of the fittest, and the weak will get trampled and the strong will survive. So it's best to understand that the government is not going to be there to make the best decisions for you. Never. Not one. Even if they promise that they're going to do it for you, it won't, right? Because that's not what they do. You are responsible for yourself and understanding what it is that's happening out there, good, bad, or ugly, so that you can position yourself appropriately for it. That's it. That's the only thing you can do. We can't change government. Even if we were to change government and say, hey, man, you have finally conducted yourself that's most appropriate for me, guess what? It won't be appropriate for that dude over there, and he's going to want to change government to make it appropriate for him. All right? So this is the battle that we all fight, is that there's no way that they can conduct themselves to make it appropriate for everybody. So you must do the appropriate thing for yourself based on the decisions that they are making. Okay? And most of the decisions that they are making is just absolute credible threats pushed out there into the mainstream media to get the fear and anxiety well elevated so that they can control you. That's what's really happening here. See, I'm not scared of it, and I don't believe any of it, and therefore I'm not controlled by any of it. Like, all these other people are like, oh, no, you're controlled. Think about all these different reasons that you're controlled. And I'm thinking, yeah, that's the meaning that you're giving it, and you are definitely being controlled by that. I don't give it that meaning, right? I don't condition my life to be subject to a politician's decision. And people are like, how could you possibly say that? All these decisions that they make and impact their particular life in all these dramatic ways. And I'm thinking, yeah, that's the meaning that you're giving it. I don't give it that meaning. Yeah, like I didn't give it that meaning that they're destroying my life, so therefore they don't. I just make the appropriate decisions that then elevate my life regardless of what they're doing. That's it. It's just like, I will take on any situation. They want to end the fiat currency system. You want to end the Fed. You want to go to cryptocurrencies. You want to go to a gold standard. Whatever. I'm down for it. Let's do it, man. Let's do it. I'm not really a fan of the experience that you're going to get by going back to a gold standard, watching retirees suffering in the streets with nothing, But, I think I might do pretty well in that kind of environment. So, let's bring it on. Yeah. All right. You can still find cheap eggs at Sprouts and other places. All right, it's wicked alarming out there realizing how many people think that the government does good and will be there for us when it matters. Truly insane. Yeah, that's a very scary thing to think about, and most people kind of see it that way. They're thinking, oh, well, what about our health, and what about our food, and what about security, and what about and on and on and on and on. And I'm like, you are 100% responsible for all that stuff. There is nothing within a statement that gives any kind of requirement out of anybody to provide that to you. There is nothing, literally nothing, right? But then all these individuals come out and it was just like, oh no, entitlements and healthcare and other nations have it and all this other stuff. And I just laugh. I just laugh at all that. And I'm thinking, yep, these are the people who are subject to their decision making and they suffer the consequences from it. I don't. Like right down to insurance, like any kind of insurance. I really don't trust any of it. Social Security, none. Like my mind does not even register that we have that coming. Right? Like I just don't expect it. Period. I do not count on it. I do not think about it. Nothing. Right? So if it's there and I get it, hey, cool, bonus. But, in my mind, people are like, well, let's argue and talk about the Social Security and how it is that they're going to, and I'm like, no, that's all up to you. I'm not doing that. That's not something I'm incorporating into my life, right? See, this is the meaning that I have given Social Security. And see, by doing that, now the government and their decision-making on Social Security and what it is that's going on out there doesn't affect me. They're like, oh, they're going to take it away from you. And I'm like, take what away? The Social Security, oh yeah, that thing. I forgot about that. I didn't even know I was having. Yeah, okay, whatever. Wasn't planning on it anyway. Right? Like that's literally the attitude that I have. So when I hear people talk about Social Security and stuff like that, to me, I'm thinking, oh yeah, that's not really something that I care about. It's not important to me. They can make all the decisions that they want about it. To me, I look at my check and that's my old people tax. That's what it is. I pay an old people tax. I don't have a problem with it. It's cool. Yeah. I mean, something's got to happen for the people out there who are, disabled and elderly and can't take care, can't go out there and work. I mean, something's got to happen for them, right? So that's my old people tax, and I don't expect it. I don't expect to get mine. So you're saying none of this means anything? Well, John, again, that's the meaning that you have just now given the information. Right? That's not if it didn't mean anything, I wouldn't be out here doing this, right? So because you have given it that meaning, this is now the information and how you're receiving it is now it's pointless to you. Right? Well, maybe it is. All right, I say the exact same thing, Simon, about Social Security. My dad calls me negative. Hey, it's not negative. That's a positive way of looking at it. I pay my old people tax. Don't ask me to defend it. Don't ask me to fight for it. Don't ask me to do anything about it. If you want me to participate, that's it. I am participating. Don't ask me to do anything else. Don't ask me to vote for people who are going to protect it. Don't ask me to vote for people who are going to take it away. Don't ask me for anything that comes from Social Security. I am not playing that game. It's an old people tax. I'm washing my hands of it. It's done. Right? It's not negative or positive. That again is the meaning that people are giving things. What time is it? What time do I? Okay, I got a few more minutes here. All right, the uneducated communist. Good one, man. All right, $5. Thank you so much for the $5. If you are looking for someone to solve your problems, someone will, but it won't be who you choose. Man, ain't that the truth? Thank you so much for the super chat. I really appreciate it. Did I get another one that I missed or something? What's going on here? All right, guys. Oh, there we go. $2 from Zeke? I'm not sure how to say the name, bro, but I really appreciate it. $2. How much? Oops. All right. How much more effective would Social Security have been in spy? I don't know, man. It probably would have been great, and everybody would have had a lot more money. But I mean, that's again, it's not the point of it, right? Oops. Hold on one second here, guys. Oh, phone's dying. Put my battery in here. If I can, I'm gonna bounce it up here. Hold on one second, guys. Plug my phone in. Okay, you still with me? Oh, stay. Maybe. I don't know if I can get this thing to... Ha! Ah! It doesn't want to stay on the lens, guys. Sorry. All right, got it. All right. Thank you for going through that. Sorry. Hope you all don't have a headache or anything or too dizzy. Do MAGA voters still believe we're heading into a golden age of America? Who knows? All right, it will take at least a decade to get all funny money out of the system. Yeah, it's probably going to take a lot longer than that. The uneducated communists, I know, have a head wound. All right, beloved, you're never met an economist, bro. Beloved, you've never met an economist, bro. Huh. All right, that was a good moment to giggle. All right, if we leave education to the states, it will be bigger wealth gap in education. All right, as a conservative Christian, Trump had a layup and blew it. No, I don't think so, Kirk. I mean, think about it in the fashion that I'm trying to describe it. Like, you know, every time that I've heard Trump come out and say something of the effect that he wants to fire Jerome Powell, I think to myself, you know, he appointed Jerome Powell. He was basically the guy who signed him up, right? I mean, Powell worked his way up into the ranks, and then he was appointed by Trump, and then immediately like hated him. And I thought to myself, man, what an odd thing, right, to have happen. Here you got the guy who's in charge of the central bank, who's basically in charge of all the money, and you have the president of the United States, and the president just absolutely hates this guy and goes on and on and on and on about him. And I think to myself, now, Trump, you're smarter than me when it comes to the Federal Reserve. He's smarter than me when it comes to monetary policy. He's smarter than me when it comes to business and investments and all the other stuff. Donald Trump is way smarter than me. Okay? I'm willing to admit that. Why is it that he says that firing Jerome Powell would be a good thing when you have 11 other members who vote on monetary policy who are not going to change anything about the way that they feel or think or believe or vote when it comes to monetary policy? Literally getting rid of Jerome Powell is like shooting a messenger. Why is he so adamant about shooting the messenger? Does that make any sense at all? Like, bang, took care of the problem. How are you guys voting? The same way. Oh, well, that didn't take care of the problem at all. Like, I know he knows that getting rid of Jerome Powell doesn't do anything to change the vote of the FOMC, the Federal Open Market Committee, right? They're the people who vote on monetary policy. Jerome Powell talks about that. He delivers the message for the FOMC. He is a messenger. That's it, right? So when I think about that for just a minute, I sit back and I'm like, wait a minute here. These two do not like, they talk about how they do not like each other. That's not the case. That's not the case at all. Donald Trump is doing the Federal Reserve a favor. By creating the massive uncertainty within the economy, it raises the inflation expectation and raises the neutral interest rate. The Federal Reserve can say, oh, thank God, we don't have to do nothing. Look at Donald Trump go. Man, grab that mic. Get the mic over there to Donald Trump. Let him go off on that thing for a while. Look, we don't have to do anything. We can just sit here and watch the Fed funds rate stay right where it's at and watch the neutral interest rate find its way up to the Fed funds rate. And the entire time, the Federal Reserve was just sitting there doing nothing except for promising to do something far out in the future. This is like, it's working. It's like totally working for the Fed. Like, if you look at it and say, hey, man, they're arguing, they're fighting, and all this other stuff, then you could probably produce all the evidence that shows it. But when you look at the reality of the situation, and you say, okay, well, wait a minute, the Federal Reserve is looking for elevated inflation. They want inflation moderately above 2% for some time. They want to raise the neutral interest rate. All that stuff is occurring. And it wouldn't be taking place if Donald Trump wasn't threatening all the tariffs. It wouldn't be happening in this fashion. So again, I look at that and I'm thinking this is not a problem for either one of these dudes. This is a solution. to their problem. Because when the Federal Reserve has an elevated neutral interest rate, if there was a time in which that they did want to stimulate the economy, they will have the ammo, thanks to Trump's credible threats of tariffs. Like, to me, they're in cahoots. This isn't something that they're fighting over. This is something that they're like, in the background giving each other high fives. They're like, dude, we did it again. We're doing it again. We did it at COVID. We did it before that. We're doing it again. Right? But we can't let them know that we're in agreement. We have to let the people know that we're fighting, because it's like professional wrestling, right? We want to tear each other's heads off on the stage, but in the background, we're actually planning and rehearsing and choreographing this stuff out. All right, what time is it? Oh, man, guys, this is getting close. I got like 5 more minutes left. All right. Let's see here. We're all equally broke. I don't think so. I think there's some people out there who are absolutely killing it. They don't have any problems with anything that's going on. In fact, they're really enjoying it because they are doing so well right now. All right? Those are the people who understand what's going on and know how to position themselves. Trump's scapegoating Powell, duh. And I mean, it's working too, right? You are overthinking this. Absolutely not, Lex. Absolutely not. I am not overthinking this at all. The reason why I'm not overthinking it is because everything that I am describing has been described by the Federal Reserve within their own statements through the speeches. I mean, I see you're a member of the channel. Go through all the speeches. I mean, I got how many dozens of member-only videos breaking down the Fed speeches, talking about the monetary policy. I mean, make that dollar work for you. The information is there. This is, I mean, once you see it, once you start recognizing it, and once you start putting all those pieces together, because it takes, I mean, you got to go back 20-something years with these. I brought the speeches into a concentration of about a dozen of them, right? Now, you could probably get away with a few less, right? But there's about a dozen speeches. If you read through those and internalize them all, you will see it exactly the same way I am, right? But if you try to incorporate the idea that there's some strategy that is now new to the monetary policy, then you'll miss it. Because there's all kinds of stuff that's happening that they're talking about that seems like it's new, but when you really break it down for what has occurred from the past with the low neutral interest rate and the low Fed funds rate and the absolute necessity to try and not even try to make it happen, increase the inflation expectation, to raise the neutral interest rate, when you listen to them talk about how much that they were concerned about creating an environment to make that happen, there is no way that any of this stuff is like, snap decisions. It can't be. They've been planning this for over 20 years. And better than that. Like, I mean, you think about it. If Ben Bernanke could put that speech out, Deflation and How to Prevent It from Ever Occurring Here, describing that of quantitative easing and the great financial crisis literally 5-6 years before it happened, you know that he was discussing it and was theorizing on it well before he gave that speech in 2002. So this is going back how many decades? It goes on and on. However, if you didn't know about the Ben Bernanke speech, and then you didn't start putting all those pieces together, monetary policy strategies for a low neutral interest rate world, from John Williams in 2018, November of 2018, talking about how the problem that they needed to solve these days was the risk of inflation that was persistently too low rather than too high. This is what John Williams was saying. I mean, this is New York Fed president, has a permanent seat on the FOMC so long as he's president of the Fed, or the New York Fed. This guy is incredibly influential, and he was straight up saying it. The problem we need to solve these days is a risk of inflation that is persistently too low rather than too high. The problem they needed to solve was to get inflation too high. They got it, right? And everybody says they screwed up, that they don't know what they're doing. And I'm like, no, they said that this is what they wanted to do. Right? And the reason is to raise the neutral interest rate. Why? Because that way they can get their ammunition back, which is having an elevated neutral interest rate, an elevated Fed funds rate far above the lower bound of zero. Next time they go into a crisis situation, they can drop far enough below neutral and actually stimulate the economy. They will probably do quantitative easings and all the other stuff along with it. But this is what they are trying to do, is get that ammunition back. In fact, since they've already learned how it is that they can conduct monetary policy using their words and not so much with their actions, they could probably keep the Fed funds rate elevated and not even drop it during the next recession, because they have all these other tools that they have developed, considering the fact that the Fed funds rate adjustments was no longer an effective tool. Now that they have developed all these other tools to deal with the fact that they were at the lower bound of zero, it's just like, man, do we even really need to adjust interest rates? Maybe we can just talk about adjusting interest rates going into the future, and that would be enough. And sure enough, it's working, right? What are the mortgage rates doing? They're dropping off of the expectation that the Federal Reserve is going to be dropping some point in the future, and they're doing it for supportive purposes and not necessarily doing it for recessionary pressures. If they were doing it for recessionary pressures, you would see the mortgage rates move the opposite way. Again, I've described this over and over and over again, and I know it's hard to internalize because there's nobody else out there who is going to deliver the information like this. I am literally the only one. I gotta go, guys. This was fun hanging out, and I would love to keep breaking this stuff down because I feel that it is incredibly important. The more we do it, the more we understand it, the better it is for us. All right, Simon has a nice theory, but the Fed will cut rates. So ultimately, Simon has no idea what he is talking about. Well, beloved, what is that? Beloves, whatever the hell your name is. Go find another channel to be on, bro. Obviously, this isn't working for you. You obviously know better than I do about what it is that's going on with monetary policy, even though I've been accurately calling this out for years. But since I have no idea, why don't you just find another channel to be on? I mean, you don't have to be here, right? You know, so go on with yourself. All right. Pigeon Post, thank you so much for that $2. Let me get it back up here real quick. Where did that go? There it is. All right, a whole lot of KFAB, whatever that is. But will they decide to either do quantitative easing or tightening? Well, they're doing quantitative tightening right now, and there is talks about adjustment of the balance sheet, like, you know, changing how it is that they are dealing with it. But ultimately, they are in a quantitative tightening position right now, and they are going to continue to be restrictive with their monetary policy going into the future. You know. And when will they decide? It's when labor. It's when the unemployment rises, right? Because the dual mandate is they're mandated to have stable prices with low inflation, whatever the hell that is, and low unemployment, right? So a tight labor market and low and stable prices. That's their mandate. That's what they're mandated to do. So if they are bringing inflation down, right, but they're modestly above 2%, if they're achieving their inflation goals by bringing the inflation down and unemployment stays low, then there is no reason for them to cut. I mean, I don't care what happens with the stock market. I don't care what happens with the housing market. I don't care what happens with any of that stuff, right? If there is a financial crisis and credit markets start freezing up, that might be one thing. But when it comes to the economy, that's their only two things that they are mandated to deal with, is to have inflation low and labor market doing well. Like full employment is the way they call it, but there is no real description of it. So basically, if unemployment rises or if you have inflationary pressures moving up, then that will force them to have to react to that situation. But if those two things are being met, they have met their dual mandate. They are achieving their goals. Like, they're not being forced to do anything. Yeah. It looks like you are getting new viewers. Oh, absolutely, I am. There's a lot of them, and you can tell because, you know, it was funny because yesterday's video was really popular. I mean, it's gotten like 40,000 views or 38,000 views or something like that, and it was incredible to see how many people were just absolutely bashing me in that video. I was just giggling every comment that I was reading. What I love best about it is when I have people accusing me of being a Democrat and then other people accusing me of being a Trump supporter. And I'm thinking, man, I know I'm over target if I have both sides accusing me of being on the other side. Like, that's when I know that I'm really, really over target. Like, I am the more I hear that, the more accurate I know my information is. Uneducated economist, you guys let me know.